Okay, welcome everybody to the Ultimate Advisors Resource Podcast. I'm Jordan Pence with Advisors Resource Company, president of Advisors Resource Company, and we help advisors like you write more life and annuity business. And today we've got another regulatory update. Now, some people called this AG49-A update. I called it AG49-C. I'm not even sure if that's the right thing to call it, but I've heard a lot of different things. I don't think it really matters what you call it, but it's just an update to um, actuarial guidelines, which are simply dictating how illustrations can be run, what they should look like, how you can illustrate these products, that sort of thing. And specifically, we're talking about index universal life. So, in case you've lived under a rock or you haven't been in the life insurance business for the past, however long these AG49s have been going on, um, there's been a lot of changes over the years to how you're allowed to illustrate IULs specifically. And it all centers around illustrated rates and loan spreads really, and how you can illustrate some of the bonuses and things like that. But really, if you take a step back, it all is centered around loan spreads and illustrated rates. That's what most of AG49 has been. AG49A, AG49B, and what I'm calling AG49C, I guess it, this some people think it's it doesn't really matter. It's just a different change. So before I get started down the new updates, let's take a little bit of a history lesson. So the big two things that happened with AG49, the first one was they limited the loan spread and the illustrated rate, but it was mainly the biggest change was the loan spread. They limited the loan spread from whatever it actually was, which it could have been, shoot, I mean, you could illustrate at one time a 3 or 4% loan spread in an illustration. Typically, actually, what we did back in the day, like back 10 years ago or whatever, when AG49 wasn't a thing, what we would do is we would actually artificially increase the variable loan rate to kind of get that spread down. So in theory, it was like sort of the Wild West. So you would see these illustrations where you could borrow in and out of the policies and it would like grow to a gazillion dollars and things like that. But to be fair, it illustrated actually how the product worked. So what AG49 did is it changed that loan spread first to 1%. And I guess before I get way in the weeds, what I'm really talking about is the loan spread between indexed or variable loans and the rate of return that the illustration is earning or that the policy is crediting. So like if you borrow a dollar out of the policy, they're going to charge whatever the loan rate is, and that dollar is still going to earn whatever the index earns. That's what I'm talking about with the loan spread, the difference between the gross rate of return and the loan rate. So anyways, AG49A, I guess we'll call it, um, it it limited that to 1% and limited some of the, the illustrated rate. Now then, carriers, companies, actuaries, they came out with the multipliers and things like that. And the loan spreads end up ballooning up again, and we had big loan spreads. So the answer to that was get rid of the non-guaranteed bonuses, move the loan spread down to only 0.5%. So now today we're only allowed to show a loan spread of 50 basis points. And then if I add on to that, um, basically the carriers, their answer to that was vol control indexes and guaranteed bonuses to get the loan spread back up. So the best illustrations you'll see, like in best, I mean like highest illustrating income, you'll see these carriers will have like a 2% bonus on the loan balance, a 1.5% loan balance, a bonus on the loan balance. So in effect, all the companies have sort of circumvented AG49. Not all of them. There's some that aren't doing this, but many of them have kind of circumvented AG49A, AG49B through these back end interest rate bonuses. Uh, you know, it's a cat and mouse game. But anyway, so the newest update, AG49A plus or C, whatever you want to call it. This is the newest one that's just went into effect as of April 1st of this year, 2026. And so I actually think this was good. I out of all the AG49 updates, this was actually one of the better ones that I think probably needed to happen. But what it actually does is it doesn't allow you to show backcasted performance on essentially these engineered indexes. So you would have these indexes that were invented like 1 or 2 years ago, and they would show back-tested performance, and the performance would be fantastic. It would average, with the participation rates, with the caps, if they had caps, it would show a backcasted performance of like 10% on average. And they were actually putting that in the illustration. So people were looking at the illustration saying, holy cow, this index, the I'm not going to name any names, but this excess return 5% index is, that averaged 15% over the last 10 years. We should do that one. Well, it was somewhat unclear that that was all back tested. And if you asked me today, hey, design an index with these features based on this historical performance. Well, if you're not an idiot, you can do that all day long and come up with something that on paper looks fantastic based on back tested performance. The downside is, number one, that's easy to do and engineer it to whatever you need to do to get it to look good. But number two, it's sort of unrealistic, honestly. Now, what this didn't do is this didn't change the illustrated rate for any of those vol control indexes. So you can still run them at whatever illustrated rate you could before. This really just changed the fact that carriers cannot put that back-casted performance into their illustration. So it has to have at least, at a minimum, 10 years of returns since its inception in order for the hypothetical historical performance to be shown. So again, I don't think this is a bad thing. I think this is actually a really good thing because, again, these back-tested, back-casted, whatever you want to call it, performance data from the past, when you apply the algorithm of something that was created today with the benefit of hindsight, in my opinion, is pretty unrealistic. So everything else is going to remain the same inside the illustration, inside the policy. This doesn't really change anything for the policy, the IUL, or the proposal. All it is taking out that section where you can see the historical performance of ABC vol control index or whatever the index is that does not have at least 10 years of actual historical performance. Quick and easy, not too much complication with this. Pretty straightforward. Not a lot has actually changed. And again, my take on this is I'm actually happy about this. I think this was a major positive. I think most people would agree. If you've been in the annuity space, you already sort of know about the vol control indexes. The life insurance is maybe a little bit newer to this, but It's really just simply the eliminating the historical performance. So thanks everybody for joining me today. This one was quick and pretty straightforward. If you have any questions, feel free to write them in here. I'd be happy to answer those. But pretty simple. If you have any questions on the old AG49, feel free to email me. Feel free to message me here. Be happy to answer those. But thanks everybody. Thanks for joining. Happy that you hope you found this interesting, and well, feel free to reach out. Thanks.